All right, I think we're going to begin. I know there are a lot of you still in line and that you'll be finding a seat. If I can ask people to make it as easy as possible for them to be able to get 2 seats, that'd be great. I don't know if shifting that direction is doable, but we'll get going knowing that people are going to walk in front and all that kind of thing, but we want to start the conversation. My name is John Cusey. I manage government relations for AEI, and I want to welcome you. This is the first time we've done Red, Hot, and Blue, so you'll have to give me some feedback on whether that was a success or not. I know it takes a little longer, but I want to welcome you here on this, one of our series of events on the Farm Bill. This is something that those of you who have come to our other events know Vince and Barry and have heard them speak before. Today we have a couple of goals. I know this is a big week. We have the Farm Bill Now lobby on the Hill today and doing their conference or their rally. And so we wanted to talk about a couple of things. The first is to talk about that there are a number of different reforms that have not been really talked about that much that still could be done to farm programs, and that's why we have the AmericanBoondoggle.com website that we set up. We launched that earlier this week, and a lot of the materials out on the front table go program by program on different reforms, whether it's crop insurance or the sugar program or the dairy program. We would love for you to take advantage of those and look at those. So there still are more reforms that need to be done than even have been discussed so far. And the other is to talk specifically about the House version that has the price loss coverage program. And this is the first analysis of what that program would look like based on different costs or different prices for different crops. And so we want to make sure and release that to you, discuss that with you as well. And the other thing is, since AEI is a think tank that does a lot of economic work, we also want to talk about the issue of fairness. And this is something that we talk about a lot of the numbers and a lot of the kind of the economics of it, but it's also a fundamental issue of fairness of who should be getting what, who should be paying what, and we'll talk some about that as well. Since we already are starting a little bit late, let me hand it over to Barry, and he'll go first, and then Vince.
Okay. Well, thanks, John, and thanks everyone for coming to hear what we have to say here, and we certainly appreciate AEI sponsoring this work and putting this event together. I'm going to say some things that if you've been at some of the earlier talks we've had that you've heard before, but I think it's important to put the Farm Bill in the proper context, and so we're going to talk about really some of the ag economy issues. Things have changed, of course, with the drought, and we'll say a bit about that here, but you know, it's been a difficult picture to really focus on what's happening with the Farm Bill, because it's been sort of a turbulent year as we've been talking about it, but there are certain things that we know for sure, and things that, you know, we're starting to get some ideas about where things are going to be. It's certainly the case. We've heard a lot about how terrible the drought is this year, and it has been quite bad. But in fact, I'll give you some specific numbers here in a little bit. But U.S. agriculture is actually going to have a good year on whole. Farm incomes are going to be up 3% from last year. So in spite of a drought, things are still going along quite well in U.S. agriculture. It seems clear, most of us, I think, it came to the conclusion quite a ways back that direct payments were getting harder and harder to justify. Payments made directly with no direct production tie or price tie, and often going outside of the farm sector. Seems like those are likely to be gone. And the role of crop insurance it continues to increase, becoming more and more prominent. It's the largest ag commodity program budget item now. It's where so much of the money is going, and there will be a lot of outlays this year with the drought, of course. One thing that I've mentioned, Vince and I have done several talks outside of here among some of our professional colleagues, and one of the things we've focused on is really the fact that there is a lot of potential for private risk management innovations in that sector, financial innovations to be carried over into agriculture. But when you're subsidizing insurance, which it's really hard to even think of this and compare it to commercial lines of insurance, but when you're subsidizing it to a 60% premium subsidy plus operating costs for the companies, no private market mechanism is ever going to stand a chance in competing against that, and we've seen that, in fact. It seems likely that budgetary pressures and deficit reduction is still relevant. We hear a lot about that in the ongoing discussions. Some version of the shallow loss program is very likely, and Vince is going to get into the details on that here in just a second. And John and I were just putting down odds on what we would see with the Farm Bill this year, whether we would see it or not. But just to give you some perspectives, and I pulled these numbers off of USDA's website 2 days ago, just to give you an idea of what the overall financial health in agriculture is. And again, I said it's up actually 3% in spite of what turns out to be in some places a very bad set of growing conditions for corn and other crops. 2011 relative to 2010, 30%, 27% before that. So we are seeing some rather substantial increases in farm income, and I think it's important to keep that in mind as we talk about policy. The 2012 drought, and we could have chosen a lot of crops to look at here, but the red line you see is really the percentage of the corn crop that's rated as good or excellent. So certainly we've had a bad crop this year. I don't think it's, in some cases, it'll be as bad as we might think because of some of the technologies that have come into agriculture. But certainly, this is the most recent crop condition report from NASS. We see yields are down, no doubt about it, and yet farm incomes continue to rise. And there's an interesting philosophical question, I guess, as to really why that is. And a lot of it has to do with subsidized crop insurance. And Vince and I just did a simple example of a corn farm that at the beginning of the year, the price was, I think, about $5.80 that was projected to hold. And if a farm had made their normal crop in that year, they would have had gross returns about $908 an acre. This year, with a 50% yield loss, if this pays out at what prices are looking like they're going to be right now, if that farm had taken an 85% coverage, their revenues are going to be $1,100 per acre. 640 of that, 650 from corn sales actually in the market, and nearly a $500 crop insurance indemnity payment. So it's really sort of an odd set of conditions. These are things that Vince and I have talked about before, but there is a conventional wisdom. We hear it in the rhetoric, we hear it in the discussions about the Farm Bill, that these subsidies are intended to save the family farm. Small family farms are really who these are targeted at. Farms are at an unfavorable financial position relative to other businesses. We just looked at the balance sheet and we see that that's not necessarily the case. There's a perception that farms have lower incomes and less wealth, that they're highly leveraged, they have very low returns to equity, that farm earnings are immensely more risky than other small businesses who have to operate in the economy tend to realize, that farm businesses fail at a higher rate than non-farm businesses. We often hear that these subsidies are intended to be rural development mechanisms to help rural communities. An issue that the WTO is really disciplining what the Farm Bill turns out to be. That's something we hear less and less about, I think, but it's still in the background. And then there's an idea that farm policy is mainly about resource and environmental conservation. In fact, just to present you with some numbers, and these don't get updated as often as I would like. I looked at them, but you still get the general idea. This is a comparison of incomes of farm households relative to all households in the U.S. economy. And agricultural households, on average, take the median, whatever statistic you want to look at, but the central tendency is that they're doing quite well. Yes, there is more risk, year-to-year volatility, but farm households have had higher incomes sustained over the last several years relative to all households in the economy. In terms of wealth, you get a similar picture, but it's actually quite exaggerated beyond that. Farms, we've seen a huge run-up in asset values, land values in agriculture, and farm households tend to be, on average, immensely wealthier than non-farm households. And you see that the percentage of farms that are in a high-income, high-wealth category is quite substantial relative to the whole pool of farms that are out there. Farms tend to have low financial leverage. And in fact, this is the ratio of their debts to assets, which is a statistic economists often look at to see how highly leveraged one might be. And this is at an all-time historical low, and I think continues to go down as asset values increase. So it's not a fair assessment to say that farms are necessarily highly leveraged. Farm failure rates. Vince and I looked a few years ago at really what the overall failure rate of small businesses in the economy that have less than 10 employees, which I think is a fair comparison for the typical farm business. And it's a huge difference in terms of farm bankruptcies being quite low and the percentage of businesses that disappear each year over time. I think it's very relevant, a point that's often missed. I teach undergraduate ag policy, and I think all of us, when we go through this each year, are surprised that so much of the land is operated not by the operator, or not by the landlord, but it's operated by a tenant farmer. The operator is renting their land. And if you look there in the Corn Belt and in the Delta, you see that these proportions are very high. It's roughly, according to the 2007 census, roughly about 40% of U.S. crop land is operated not by the owner, but by someone who's renting that land. And the relevance of that is really where these subsidies actually end up going. The check may be sent to the operator, but a landlord is very effective, and we've done research on this looking at it. It's very effective at extracting a share of those subsidies through higher rents. It's just the way markets work. So some issues, I think we've seen several proposals here. The administration proposed $33 billion in cuts. We do have a Senate Farm Bill that's been approved, and the supporters claim there that it's going to save $23 billion. We had several months ago a budget resolution in the House that would have had some substantial cuts, not a lot of traction there, I think. The recent CBO scoring estimates on this, crop insurance, about $9 to $10 billion a year, $91 billion over 10 years. Conservation, $64. Commodity programs, $63 billion, and nutrition, of course, the largest share of the pie, $772 billion. Again, there is an issue that I think Vince is going to say more about, but really, we are looking at tying support with doing away with direct payments and some of the alternatives that are being proposed, sort of a recoupling of support back to production, and that does have some important implications for our WTO obligations. One thing that is, it's inherent in the ACRE program that we have right now that hasn't really had a lot of participation, but certainly the shallow loss programs that we're seeing proposed and discussed really have many of the same features here. It's ratcheting up the support level. As prices improve, as yields improve, the guarantees, the revenue guarantees that we're giving also improve. And that doesn't necessarily have any tie to cost of production. In fact, if you look back at the balance sheet I gave you, that you see cost of production are not rising at nearly the rate, and that's why gross incomes are increasing so much. But I think there's an important question we all should ask is why taxpayers, why should they increase support levels when prices and yields and incomes are growing? It seems a little bit odd, but it is a feature of these shallow loss programs that we see. And certainly as you subsidize risk, subsidize losses, the result, first principles, is you're encouraging agents to take on more risk. So there's important distortions that could happen there. And really, to have guarantees of the revenues of the level of what we've seen lately is really unheard of, at least in my limited experience in other sectors of the economy. And I'll just give you a quick picture here we put together of what happens when you look at basing support on Olympic yield averages and a 2-year price average. You're ratcheting up the level of guarantee each year. Now, of course, the drought is going to change that a bit with lower yields, but of course, it's these Olympic yields would drop that out, presumably. But you look at what the state Illinois acre revenue guarantee has done over time, and it's gone up considerably.
Barry's laid out the background and the context for where the House and the Senate bills are, in a sense. It's showing where the agricultural economy is relative to some of the proposals. We have previously in May issued a report looking at the costs of the Senate shallow loss programs. Those programs are going to score if you assume CBO baseline prices, and those prices are at or near current record levels. It's going to score at about $6.5 billion, somewhere between $6 and $7 billion a year. I'm sorry, if it scores CBO, it's going to be between 3.2 and 3.7 billion. If prices fall substantially, they moderate back towards their fairly recent historical levels. Not very low as in the early 2000s, but somewhere between there and where they are now. The Senate bill will score between $6 and $7 billion. That's more than we're spending on direct payments by $1 to $2 billion. We thought it would be important to share with you, what the House proposal, which critically has 2 elements, the price loss coverage and a special sort of new insurance-based program called the, I've forgotten, the SCO, the special, I want to call it special coverage option along the lines of Saturday Night Live, but I should really call it the supplementary coverage option. We thought it was important to look at the potential costs of those 2 pieces of proposed legislation along the same lines, using the CBO prices that we used in our May study of the Senate bill, and then the same longer run historical average prices, but not very low average prices, to see what the cost would be. The technology we're using, the analytical methods we're using, are very similar to those used by most other groups looking at these costs. We differ a little bit from the factory estimates in that we do not assume changes in land use, but pretty much it's a similar approach. We do not assume farms make substantial adjustments. That's what's built into the Texas A&M approach. But otherwise, we're very similar. We're in some ways a lot more conservative than either the Texas A&M or the FAPRI approach, in that, as you will see, these programs give incentives for different crop production to be expanded, and we're not taking account of that potential. Right. What is the structure of the price loss coverage program? Well, I don't want to get into the weeds here, but essentially, there's a reference price established for each eligible crop. If the market price, on average, over I think it's the first 5 months of the marketing year, falls below that, then a payment is available for eligible quote production equal to the difference. So if for wheat, the support price, the reference price is $5.50, which it is in the bill, and you get a $5 wheat price, 50 cents per bushel gets paid to the farmer. What's it paid on? His recent, almost surely, historical average yield over the past 5 years, 2008 to 12, and what's called the farm's total base acreage, up to acres on the total farm base acres. It turns out that there are very complex rules built into this that effectively mean that every acre that you plant will have one of these payments. You will get a payment equal to, say, that 50 cents per bushel times however many bushels you averaged over the previous 5 years, times every acre you plant, as long as you don't run up against payment limitation rules, which are pretty generous for this program. So in our analysis, we've assumed everybody gets paid on every acre they produce. What else do we know? Well, out of the PLC program, it turns out that payments are tied to recent yields, and that because farmers receive a payment on every planted acre for the crop, multiplied by 0.85 or 85%. Why that number? Because that's historically embedded in the direct payment rules. But it turns out that effectively you get paid on every acre, so this is clearly a program that is directly linked to and will affect current production decisions. And there's no ambiguity about that whatsoever. What do these effective prices, these reference prices look like? Well, they're actually high relative to the sorts of prices that have been used to trigger payments under price support programs in the past. For example, relative to the effective trigger for payments under the current counter-cyclical payment program, the corn reference price is nearly 60% higher. It's 50% higher for wheat. It's 50% higher for soybeans. It's 72% higher for rice, extremely high. And it's 17% higher for peanuts. Are these reference prices prices that would have triggered payments over the last 10 years? Well, the answer is yes. So if we take a look, and what I've got up here is the peanut market. In every year, but the forecast price for 2011, in every year, peanut producers would have received very substantial payments. The horizontal line is the peanut reference price. So for those of you from Georgia, your growers will make out like bandits under this program. And as you'll see with the numbers, they do. I'm not suggesting they are bandits, but they'll make out pretty well. Well, maybe they are bandits, except for President Carter. What about rice? Well, very similar story for rice. Rice would have been paid in all but 1 or 2 of the years of the last 10 years under this program, and very substantial amounts in many years. A 14-cent per pound reference price, and the rice growers in California are going to be very happy with Congress if this bill gets passed in its current structure. And I wish I owned rice land. Now, what about corn? Corn, in the early part of the last decade, would have had substantial payments. As the renewable fuels mandate kicked in and prices for corn have jumped, we'd have had 1 year with small payments over the last 5 years. If the renewable fuels mandate, the ethanol mandate, if you like, is relaxed, and it's relaxed on a multi-year basis, we can accept corn prices not to go back to $2 a bushel, but to somewhere in the lower $3 range. That's well below the $3.70 reference price for corn. And as you'll see, will generate substantial payments. What about the general findings that we have when we run our models? And those 3 previous graphs perhaps set a scene to say there's a potential here for a lot of payments if prices moderate. Not massively, but moderate. Not massively decrease, but moderate. Well, the answer is, as long as prices stay at their current record or near record levels, this program won't be that expensive. It'll be about $1.1 billion for the 5 crops we looked at. There are crops we didn't look at, relatively small acreage crops like barley and so on. So that number's an understatement, but not a lot, not by congressional standards, a huge amount of dollars on this program. But if crop prices went back to roughly halfway between where they are now and where they were in early 2000s, this program would cost $18.8 billion a year. Not over 5 years, this would be annually. If, for example, prices only went halfway towards that mark, we're still looking at $9 billion a year. This is big bucks. This is very substantial downside risk for the taxpayer and the budget. This is not a trivial story. If we go to lower prices, these longer historical average prices, what does corn get? $9 billion a year. That's if corn goes down to about $280, $290. What does soybeans get? $4.7 billion. Again, comparable decrease in soybean prices. Wheat, if Oklahoma wheat goes back to about $350, wheat producers get about $3.4 billion. Rice gets nearly $1 billion, and peanuts get nearly $300 million, and the total is 18.8. Now, we didn't really believe these numbers, so Bruce Babcock, who did much of the analytical work, ran these numbers, and these are not wrong numbers. These are very high numbers. If, as I said before, prices only moderate halfway from where they are now to the numbers assumed here, 350 for wheat, 280 for corn, essentially you just take those numbers and divide them by 2. And that still means we're spending $9 billion plus annually on this program. Not 5 years, just annually. If we had 5 years of what are historically long run, above long run trend prices for these commodities, we're looking at nearly $94 billion going out over a 5-year farm bill. That's a lot of money. Now, let's look at payments under this program on a per acre basis. And you can see why under the CBO assumptions, corn gets relatively little compared to current revenues. It gets about $4 an acre. Soybeans get less than $1 an acre. Wheat gets about $7 an acre. And what about rice and peanuts? They get $68 an acre each. So while their totals are relatively small, their per producer payments are relatively large under CBO baseline. Where does that compare, say, with direct payments? Currently, corn producers are getting about $20 to $24 an acre in direct payments, in those lump sum payments. Wheat growers, for example, are getting about $12. So these numbers are very substantially less for wheat and corn. And by the way, they're substantially less than we estimate would be given to those commodities under the Senate shallow loss programs. Essentially, this bill reorientates monies, at least through the PLC, towards rice and peanuts and away from corn, wheat, and soybeans. If we go to historically lower prices, closer to the long-run historical average, but by no means all the way there, the picture changes. Corn producers get about $100 an acre, roughly 4 times as much as they're getting under direct payments right now. Wheat gets $64. That's about 5 times as much as they're getting now under direct payments. Soybeans, $62 an acre. Rice and peanuts, peanuts are well over $200 an acre. Rice is well over $300 an acre. And if we go to prices that are halfway between, say, $350 for low-quality wheat and $550 the reference price, these numbers are smaller. You just divide them roughly by 2. They're still looking at very large numbers, and we'd expect land prices to soar, by the way, or certainly not diminish. Very, very high rent costs. Essentially, the conclusion is that if we have moderating prices, we are not unreasonably moderating prices. We'll be looking at expenditures by the taxpayer in the budget that are roughly 4 times higher than under the direct payments program. And to benchmark that number, that's close to everything the federal government spends in the Farm Bill on farm-oriented programs. If we add in the supplementary coverage option, which is an add-on insurance option. If you buy insurance at the individual farm level already, for corn or for wheat or whatever, you can buy for that commodity a supplementary coverage option. Roughly 90 to 94% of the producers of the crops we've looked at do buy such insurance. So it's most people. Essentially, the idea is to cover shallow losses in this program. The payments are tied to county performance of yields, and essentially you get a payment when your county's yield is below 90% of its recent average level. If we run the numbers for the SCO, what do we come up with? We come up with roughly under the CBO baseline payments to farmers of about $2.1 billion, with corn getting about $1.2 billion of that, soybeans about just under 0.6 of a billion, just under 600 million, wheat about 350 million, and very small amounts for rice and peanuts because of the structure of how those products are grown and the fact they don't have much yield variability at the county level. The interesting story here is total cost is about $2.1 billion under the CBO baseline. You add that to the about $1.1 billion spent on the PLC program, which is a companion program. These are companion programs in the House bill, and you come up with about $3.2 billion. And an additional $500 million then will go to insurance companies to manage this product, because this product would be managed through the risk management agency, and taxpayers would fund subsidies for the crop insurance companies to deliver the program. If it were actually managed through FSA, by the way, which it could easily be in this particular case because of how it's structured, costs would be minimal for managing the program. You don't need to evaluate losses because you're looking at county yields that are reported by NASS. You don't need to do any loss assessment. The payment would be on an insured acre basis, which is typically all the acreage planted to a crop for an individual farm. This is a very easy program for FSA to manage, and extra costs would be in the single millions and probably less than $20 million a year. This is an expensive program in the way it's being suggested it should be managed. This program will actually cost less if prices moderated to their 15-year historical average levels, because payments are tied to price levels. So if at the county level there's a yield shortfall, how will that shortfall be valued? At the current expected price for the product, not some historical average. So if price is moderated by 40%, these numbers would drop by 40%. Let me get to the summary. Essentially, under CBO's baseline crop price scenario, for the crops we looked at, the total cost of the two programs, PLC and SEO, would be $3.7 billion or thereabouts, give or take a couple of $100 million, because we're economists and we're not very accurate. None of us are very accurate. If crop prices moderate towards their recent historical average levels, their 15-year average levels, so that's essentially 6 years of very high prices and 8 or 9 years of lower prices, then it's a $20 billion deal. It's literally $20 billion out the window in years where prices are that level. If prices moderated to where they were, and I think it's 2009, we'd be looking, because that's roughly halfway between where we are now and where our historical average numbers would be, we're looking at $9 billion to $10 billion a year. So we're looking at a program supposedly to save roughly $2.3 billion out of the Farm Bill that would actually add, in that setting, $5 to $15 billion a year, depending on how prices work. So the downside risk with this program is extremely high. Where does it compare with the Senate, by the way? The Senate in the lower price world, in the same lower price world, the Senate bill would, quote, only cost $6 to $7 billion, as opposed to 18 to 20. So in this context, the Senate bill has less downside risk. Both the Senate and the House bills, if prices moderate, will provide farmers with higher annual average payments than the current farm bill, period. What about WTO considerations? Both the Supplementary Coverage Option Program and the PLC program provide subsidies based on every acre that a farmer plants. They are clearly there for what are called amber box programs under the WTO. That is, programs that involve subsidies that directly affect current production decisions. If these numbers get larger than small amounts, almost certainly a wide range of different countries will be carefully considering bringing the sort of WTO case that Brazil brought with respect to cotton, and they'll win. There's no issue that they'll win. Currently, the US reports crop insurance as a de minimis amber box program unrelated to a particular crop. That's one reason why we have not come close to our aggregate measure of support obligation of $19.16 billion under WTO. Take the PLC program in a, quote, bad year, $18 billion, add to it $6 to $8 billion in crop insurance, and we're somewhere approximately 25% just with those two programs over our current WTO obligations, and will be subject to those sorts of penalties that arise with violating that part of the agreement. The more troublesome in some ways issue, or just as troublesome issue, is that WTO dispute panels find that a country has suppressed world market prices when world market prices fall at the same time that subsidies under a program rise. Of course, that's exactly what will happen in the PLC. And they have almost uniformly, in every case that's come before them, where there's been a significant increase in subsidies by a country in the years in which prices have gone down, found against the policies of that country, which means two things. Firstly, countervailing actions can be taken against the commodity itself and agricultural commodities. Second, a country like China or South Korea or India could levy penalties against non-agricultural commodities like intellectual property right commodities, for example, i.e. computer programs or music, or heaven forbid it would be Clint Eastwood films. All of those will be on the table for a wide range of commodities. Because the problem exists for peanuts, the problem exists for rice, the problem exists for cotton. No, not for cotton. I'm sorry, cotton has another problem. We will talk about that another time. That stacks problem, the stacks program is obviously a problem for cotton. But for grain sorghum, you go down the list. For mustard seed, for crying out loud. So from a WTO perspective, this is a problem. The House bill is particularly a problem. The Senate bill is not a problem. It is also a problem in that regard, by the way. Both the Senate and the House shell loss and PLC programs pay effectively on every acre, and they pay more when prices fall. So they have the same problem. Thank you.
Thank you, gentlemen. I want to make sure we have time for questions.
How do you, what are some factors that could actually lead to the prices going back to a more moderate level?
Let's be careful. We are not assuming that prices go back to their 2001 levels. That would be $2.10 for corn. We're assuming that prices for corn would not go back to those levels for exactly the reasons that you just laid out, that we've seen increased demand for food and for feed in countries like India and China. What we're really saying is if ethanol demand goes away, if corn, wheat, and other commodities continue to improve agricultural productivity, a supply-side effect, these are the sorts of prices that we would expect to see realized. And notice that for the PLC, we're talking about $20 billion, $18.8 billion in spending. And for the PLC plus the SCO, we're talking about $20 billion in total spending. If prices just go down to $2.80, $2.90 for corn, $3.50 for low-quality wheat. Low-quality wheat, historically in the 90s, was selling, except for 95 when we had a worldwide drought, it was selling roughly around $2.90 to $3.10. So we're not pushing prices all the way back down to those levels. So essentially, we're looking at prices that are on the low end, but on the low end of a very feasible set, especially if ethanol no longer is the green fuel of choice.
Can I just add to that as well, that your question is the exact point. We don't know. We don't know what the prices will be like. And what's happening is this is an open-ended commitment that the ag community, they're playing poker with the taxpayers' chips on this. Nobody knows for sure what it'll look like. We just know that the taxpayers are holding the bag no matter what the prices are. If the prices stay high, great. Do we know for sure that's going to happen? No, and we know who's on the hook for that if it doesn't.
We didn't start out to try and be radical here in terms of radical, here's an unreasonable, completely out of bounds number. That would have been $1.50 for wheat.
We have a question in the back.
Well, just to add a point to this, that we're talking about a 5-year farm bill here and so forth, but if you look back over the long history, what real prices in agriculture have done over time, it's been a steady, long-run decline. And technology is improving constantly. We have all kinds of forecasts about what yields are going to do over time. So there's a lot of uncertainty there, but there is a long-run trend for prices to decrease and yields to go up.
Okay, we're finally going to get to you here in the back.
Can you talk about what maybe your expectation would be in the short, medium, and long term if all subsidies and crop insurance programs just cease to exist? I mean, what would, if you just pulled it all away, what would kind of be your expectation?
Well, corn land would cost $6,000, not $12,000 an acre. And that would mean we'd see corn land back at the price at which it was trading in 2005 or 2004. We would see a substantial decrease in the value of agricultural land. And that's just the truth. Assuming that prices moderated as we have shown. If prices stay where they are and we remove all subsidies, say we get rid of all crop insurance subsidies, we get rid of all direct payments. That's the bulk of the money that currently ends up in farmers' pockets from the federal government. There's some money from conservation and so on. But that's roughly estimated, that's roughly $15 billion as CBO projects forward. So take $15 billion, and what's the market value of those crops? About $160 billion at current price levels. So that's about 10% of the market value or 8% of the market value, depending on how you want to measure it. So now double that, and that's about the proportional decline in the value of land, about a 15%. Back of my head, back of the envelope, land prices would fall by 15%, assuming current CBO prices persist. Farmers would continue to have debt-to-asset ratios that are remarkably low by historical standards. Their revenues would still be way above levels that they experienced in 2000, 2001, 2002, even though then they were getting substantial loan deficiency payments as well as direct payments, roughly comparable to what they're getting today. Land price, so that acre of corn land in Iowa that was selling for $5,000 or $6,000 in 2005-06 would now merely sell for roughly $10,500 today. And if you took the agricultural sector and you took away $5 billion of direct payments, the effect on land prices would be very modest, maybe 5%. If you took away crop insurance subsidies, and we have to be careful with crop insurance because out of the $9 billion a year, $3 billion goes to the insurance companies. Well, so only $6 billion in revenue for the farmers. So you're looking at relatively modest effects on the value of land. These are prices currently that by themselves generate far more revenues than farmers incur in costs. Prices have effectively doubled since 2003. Production costs have gone up by no more than, what, 30–35% at most, accounting for everything, energy, whatever else. You know, the gap between revenues and costs today is very significantly larger, and that's reflected, of course, in the farm income figures. So would all farms collapse? No. Would it be the end of the food supply for America? No. Would we be importing barley from Britain? Definitely not. Very little would change in terms of production. We might see a slight moderation in the use of fertilizer and chemical inputs. Much else?
No, I mean, I think it's hard to describe a world like that because it's been so long since we've seen such a thing. But and Vincent, I agree on 99% of
yeah, we
things,
do.
But I believe there's a great potential for innovation in the private sector in risk management mechanisms and that sort of thing. We've seen it in other sectors of the economy, but if you have a crop insurance program where the government is paying not just the vast majority of the premiums, but also the cost of operating the program, plus reinsuring the program, there's no way that innovation ever has a chance to even occur. So, but to be sure, and Vince said this, if you bought an acre of farmland at $12,000 this year, and you know, we did away with all farm programs, you would suffer a capital loss, just like landowners do all the time.
One of the important things to note is that actually relatively little land has actually changed hands between 2005 and today. So there are relatively few people who are actually in that position. And in terms of the balance sheets, a lot of the land transactions that have taken place have been cash transactions, not mortgage-related transactions. So a lot of the land that's been purchased has been purchased by farmers who have had very substantial cash to use to expand their operations. So in terms of the additional debt that's been taken on, very few farmers have taken on much additional debt to accrue additional land in this environment. Does that mean that nobody is at risk here? The answer is no. There are always exceptions to the rule, but they are not the majority. They're not the overwhelming majority of farmers. And given that 80% of these subsidies go to the largest 15% of operations, the effects are going to be even more moderate. Now, one of the issues that we haven't discussed at all really is targeting of help. What is absolutely clear is that the current programs, plus whatever is proposed currently in the House or the Senate Farm Bill, they're not targeted to poor, socially disadvantaged farmers. They're not targeted to the struggling farmer in Iowa that was on the PBS program 10 years ago trying to make a living off of 100 acres of corn. He gets very, or she gets very little money out of that program. So if you wanted to say there are people in the rural sector who need desperate help, these programs are not targeted to any significant degree in terms of where the funds go. In say, contrast to some degree, food stamps. I know there are issues with food stamps, but at least they're somewhat targeted.
And let me clarify that our proposal isn't to get rid of all subsidies. That if you look at our AmericanBoondoggle.com site, we're not suggesting that. We are suggesting there are a lot of additional areas where you can get savings that would not negatively impact the farm sector. We have time for one election, and there's an attempt to do a 6-month or 1-year farm bill extension. What should that look like?
Well, the simplest thing would be to have an extension of the farm bill, and the farm sector would be delighted if there were no cuts. But if the farm bill were required to meet, say, the $2.3 billion annual reduction in spending that was the super committee deal, there's an easy way to do that. You just take $2 billion or so out of the direct payments. You cut direct payments by 40%, and that gives you $2 billion right there. That is a straightforward way of dealing with the problem. It's actually a way the Senate and House committees dealt with the problem in 2008 with the 2008 Farm Bill. They needed to actually, in that case, only to save, was it $300 million a year? So they had a roughly 3% cut in direct payments for 3 or 4 years. But that's a very easy, simple way of getting an extended bill to meet the super committee deal cuts. And it's easy for USDA to manage because it's just one check, and it's not a check. It would not require new implementation rules. It's an easy, quote, fix on the budget side.
All right, thank you all for coming. And if your bosses have an interest in, I think Vince is around for a couple days. If your bosses have an interest in meeting with him and talking to him about it, we could try to come up and let me know, and we will go from there. Thank you all.